You'll discover in this video 5 of the biggest errors Warren Buffett claims almost all investors make. To be a good sport, I'll confess a few of my own investing transgressions along the way. I share with you the best advice and resources for using stock market investing to achieve financial freedom. 1. Market timing.
Charlie and I don't think about the market, and Ben didn't very much. I think he made a mistake to occasionally try and place a value on it. We look at individual businesses, but the stock market, I know of no one that has been successful at, and really made a lot of money predicting the actions of the market itself. I know a lot of people who have done well picking businesses, and that's what we're hoping to do.
Warren Buffett believes that one major error is concentrating too much on the performance of the overall stock market. This error is so simple to make that even Benjamin Graham, Warren Buffett's investing hero, was guilty of it. Why is it so tempting to predict how the market will move? The ocean's tide has the power to raise and sink all ships. You found a great stock, but COVID struck, and you lost big time. Then you discovered another fantastic business, only to experience war, inflation, and rising interest rates. What in the world? I believe that this is the reason why attempting to forecast what the economy will do on a macro level is so alluring. It sounds so simple, right? We want to buy the dips and sell the highs. It seems so simple, doesn't it? According to Warren Buffett, one should only concentrate on two things in life: the significant and understandable. It's important to know where the market is going, but can you actually predict it? Jerome Powell's announcement regarding the interest rate increase at the following Fed policy meeting is unknown to me. Heck, I doubt that even Jerome Powell is aware of that. And that's just one of perhaps 100 factors that are crucial for predicting the direction of the market. What does Buffett do in its place then? He is concentrating on finding superior companies at reasonable prices, which is both important and knowable. It is much simpler to recognize a ship's superiority than it is to foresee every storm that could possibly occur in the far future. One of your ships may sink occasionally due to hurricanes and thunder, but other times the wind will be at your ship's backs. Have faith that betting on the top boats will pay off in the long run. 2. Attaching yourself to your purchase price.
A stock at 50, somebody's paid 100, they feel terrible, somebody else paid 10, they feel wonderful, all these feelings. And it has no impact whatsoever.
Look at the graph below to see how Amazon's share price has changed over the past 5 years. Jack bought the stock in June 2022, and he has a nice 5% return right now. Given that it was only a few months ago, he probably feels pretty good about himself. Joe, on the other hand, bought the business in July 2021, and since then, he has lost 38%. And Kate, who bought Amazon 5 years ago, and is currently sitting on a nice 133% return. Due to the timing of their purchases, Jack, Joe, and Kate treat Amazon stock differently. Should the business? Perhaps Joe should wait to a break-even while Jack and Kate sell in order to secure a profit? I believe it is fairly simple to see from the way this question is presented that the answer is no. The future performance of the business is the only factor that should be taken into consideration when deciding whether to sell or keep Amazon today. After all, Jack, Joe, and Kate will all make a 50% profit from today's level if Amazon sells for 50% more in a year. They do not receive different treatment. The error here is that many investors have a propensity to become sentimental about their purchase price. The price at which you choose to purchase something is irrelevant to Amazon stock. Stocks do not exhibit empathy. Going forward, they will treat both investors who have gained 133% and those who have lost 38% on their investment equally. According to Warren Buffett, you should always act as if you have a clean slate. You'll soon learn about a mistake that Buffett refers to as his biggest mistake by far, one that is related to this one. 3. Projection of rapid growth.
I think it's a mistake for any company to predict 15% a year growth. There are plenty of them do. Very, very few large companies can compound their earnings at 15%. It isn't going to happen.
Have you ever had the thought, this stock seems to be quite expensive, but if it can just keep growing its earnings at this rate, it will soon be a bargain? Yes, I have. Many businesses with high stock market valuations attempt to defend the price of their shares by projecting extraordinary growth. However, as Buffett emphasizes, assuming extremely high growth rates is a mistake. I'm not suggesting that you steer clear of developing businesses, though. Buffett enjoys investing in growing businesses, especially if they can do it without using a lot of money. However, growth at any cost, which has been the stock market's mantra during these periods of low interest rates, is a trap. Anytime you buy a stock at, say, 20 times earnings or higher, the earnings must increase significantly for you to make a nice return. Furthermore, as Buffett emphasizes, this is not a simple task. Only 40 S&P 500 companies from 2012 that are still trading today under the same ticker symbol achieved growth of 15% or more. That's roughly 1 in 10. Selecting a 1 in 10 company is very challenging. Investors in the world's Teslas, Intuits, and Nvidias should exercise caution. 4. Leaping over 7-foot bars.
Really, the only way a smart person that's reasonably disciplined in how they look at investments can get in trouble is through leverage. I mean, if somebody else can pull the plug on you during the worst moment of some kind of general financial disaster, you go broke. And Charlie and I both have friends where that's happened to them.
Because it completely contradicts what success means in many other areas of life, I believe this error is so prevalent. You name it, climbing unclimbable mountains, jumping from unimaginably high places, and so on. Everywhere else, you get rewarded for working hard, but in the world of investing, that just isn't the case. Making difficult industry predictions or difficult mathematical gymnastics is not only unrewarding but frequently disastrous for investment outcomes. Ask the Nobel laureates and mathematicians at long-term capital management. This is related to the error of failing to see the forest for the trees. If you can locate a business with promising market and commercial prospects, where the management is sincere and diligent, and you don't overpay for that business, you'll undoubtedly succeed. Long-term success in the world of investing comes from simple ideas. 5. Excessive diversification.
We've made plenty of mistakes in acquisitions. Plenty. The mistakes are always about making an improper assessment of the economic conditions in the future of the industry or the company. They're not a bad lease. They're not a specific labor contract. They're not a questionable patent. Those are not the things.
Investors have a lot of questions about diversification. I've already talked about this on several occasions, so I'll keep this brief and direct you to this other video if you want to learn more about it in depth. It basically comes down to this: you should diversify if you aren't willing to regularly research specific companies. Most likely investing in an index fund to safeguard yourself from ignorance. However, if you are what Warren Buffett refers to as a know-something investor, someone who enjoys keeping up with particular companies and industries, you should use this knowledge to generate returns above the market. If you purchase the 30 largest S&P 500 companies, you shouldn't anticipate performing significantly better than the index participants. A comparison occurs to me. Some people back when I was younger believed that adding 40% booze to 30% booze must make the resulting cocktail even stronger. Perhaps even 70%? This is absurd because the result will only be diluted if anything weaker than 40% is added to the 40% one. The performance of your top 6 portfolio will be diluted by adding your 7th best stock pick, just like that. For the sake of full disclosure, I currently own 10 stocks, and I believe that investors will continue to argue over the ideal number of holdings. Thank you for watching. Make sure you subscribe to this channel and hit the notification bell for more videos like this, and also note that by sharing your insights in the comments, you can aid other investors.